Bloomberg Audio Studios. Podcasts, radio, news.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, in your history of being a financial journalist, what are you most proud of in terms of coining phrases? I gave you a hint just then because I assume it's mint the coin.
Yeah. Oh, good one. Yes, sure. Mint the coin. That's right.
Okay.
Thank you. Yes.
So I have a few. I have China's Great Ball of Money.
I like how you're like, what are you most proud of? And this is going to be my saying. It's what I'm proud of. But keep going.
Thank you. You called me out. Europe's sovereign bank loop, although no one believes that I invented that one. And flows before pros, which has come up quite a bit on this podcast. So the idea that, when valuations are extremely high and everyone's buying everything, no matter what the price, that it's kind of momentum that matters more than fundamentals. Today, I'm very happy to say we are going to be speaking to a pro who knows flows. How's that?
Extremely well done, Tracy.
Thank you.
Excellent setup. Of course, I appreciate all of the Tracy neologisms. Man, what a time in the market to be talking about flows, to be talking about momentum, etc. I feel like it's always chaotic. It's always uncertain. You'll never get an answer. But man, things feel really noisy right now.
They feel super noisy. So we are recording this on January 30th. It is a week that has seen a very sharp sell-off in tech stocks, thanks to anxiety over DeepSeek coming out of China. We're going to talk about that. And more generally, we're just going to talk about what's going on in the market right now, how investors might be handling it, and how the market structure might have changed over the years. And as I said, I'm very excited because we do have the perfect guest, the pro who knows his flows. He has a lot of nicknames, actually, Gandalf being one of them as well. Actually, I didn't realize one of our colleagues at Bloomberg kind of coined that name for him. But of course, we are speaking with Marko Kolanovic. He is JPMorgan's former chief global market strategist and co-head of global research. And now he's with us to talk about the market. And Marko, thank you so much for coming on Odd Lots.
Thank you so much for having me.
I'm very excited. I know I've said that 3 times now, but I guess we should start with the recent sell-off, like the DeepSeek deep stock sell-off. There are all these superlatives that you can use to describe Monday's action, like the biggest single stock plunge in history in the form of NVIDIA, and 8 of the top 10 biggest one-day drops in the S&P 500, et cetera, et cetera. And actually, as we're recording this on January 30th, Microsoft is down 6% after earnings. So maybe the tech sell-off isn't over yet. But one of the interesting things about this week is there hasn't really been broad contagion. So most stocks in the S&P 500 were kind of meh, we don't care. When would you expect some of the anxiety over DeepSeek to maybe start having a bigger impact on the broader market?
So, as you said, there was not much contagion, and if you look at the different stocks in S&P, many of them were actually up, and many even in the tech sector were up. If you look, for instance, Facebook yesterday or today, or a bunch of other names that sort of were perceived that they might be sort of benefiting from, the sort of open architecture, type of things that can come at a cheaper price, and can be still, implemented in their business model when it comes to AI models. Right. So it was fairly contained. I'm a little bit surprised just because there were 3 or 4 names that really got hammered, and that can only be explained with not just with the panic, but some of the sort of forced selling, maybe coming from options. If you're selling NVIDIA puts for the past few years, you could make a good living out of it. But then, you'll have a day like we saw this weekend, and basically you might get, forced out of these positions and maybe have a catastrophic loss. So it was fairly limited. I'm a little bit surprised, just because we didn't really have a meaningful sell-off since last summer, sort of when at the back of Bank of Japan, So I do think we will see one. Perhaps it's a little bit too early in the year. There's still quite a bit of an optimism post-election. There's a little bit of seasonality in January. People put money to work. They get paid. They allocate the capital. So maybe it's a little bit too early. I was somewhat inclined to see that we will see a bit more, at the back of it. It's perhaps not over. We still have a few important earnings to come. So it remains to be seen sort of what happens, maybe another week of earnings, whether there is any sort of follow through, But I do think that it's going to be, some investors got burned clearly, and a little bit of a tarnish on the sort of this thesis that some of these stocks like Nvidia just go up, every day. You can't lose, So I think people will think twice. If something can drop like 20% in a day, you got to also think of it, what it does to your risk. And
Well, so Tracy asked about contagion and the anxiety spreading across the market, but I guess I would flip the question, which is, as I've said before on the podcast, I'm a boring index investor. So I look at a random American company that is like General Electric, it's doing fine. I'm not very exposed to General Electric because they're a small part of the index. I am very exposed to NVIDIA and Microsoft and so forth. We did a recent episode about market concentration, but I'm sort of curious your take on this fact that so many of these flows, they go into broad market indexes, but we're really all very exposed to a few concentrated market bets.
Yeah, so the concentration is the highest, sort of 60s or 70s. So we're looking at 50 years, half of the century history, and concentration is sort of at the highest point. It's been a while for staying there at this level, maybe past year. So it's a weird market. This concentration came for two reasons. One is clearly thematic investing in technology. Then you also have investing in large company. You have a theme of momentum, sort of, that is basically self-fulfilling. More something goes up, more money it attracts, becomes bigger than index. All the passive flows into it. So there's a technical aspect, there's thematic aspect, there's even geopolitical aspect. A lot of money went outside of the other parts of the world. Europe is doing worse when it comes to sort of economy. Sure. China has been, we've been at sort of at the brink of this Cold War with China, so money has left there. LATAM has its own share of sort of issues. So money has been also geopolitically moving into it. So it's moving in the US, it's moving into indices, it's moving into tech, and then you end up with these, give or take 10 stocks that really sucked up all the capital, and valuations got very, very high. Now, tech investors, they do have a sort of their rationalization. So what's going to happen in the future? This thing is just grow and grow and grow. And that's when we saw with the DeepSeek, we saw a little bit of a dent in that thesis. But these stocks didn't go up for the sake of for the thesis. They went up some of these other flows. So unprecedented concentration is not going to stay there. The big question is, when will we see that rebalance? Do we need to see, some cyclical downturn first to purge and to normalize some of these valuations? Because historically, these PEs were never this high. I mean, in 2000, they were this high, and we know how it ended, But a lot of people got burned, myself included, with some of the call. We were more negative last year, and basically, market has this tremendous momentum. So the timing is going to be challenged.
What does it take to, I guess, turn momentum at this point? What are the catalysts that actually work here? Because it does feel, looking at the market, so much of it is now technical or systematic in some way. There's a lot of option selling, as you mentioned, lots of multi-strat funds that basically, just have to sell or buy to rebalance their exposure. What actually changes directions? How do you get enough to change a trend?
So, so there's a technical aspect, sort of the mechanical aspect of it, and there's a sort of catalyst or more fundamental angle of things, So to get things to start moving or to stall, you usually do need to have some fundamental driver of it. So perhaps there is concern about economy slowing down. Perhaps there is a concern about something geopolitically, maybe trade war with China or some sort of blockade of Taiwan Straits or something like that, right? So first you need to have a little bit of a catalyst, but if the market is technically very strong, the catalyst is not going to change the momentum. So what that means in, more specifically, so when you look at the trend investors, they have a range of signals, so they can look at the 1 month price momentum, 3 month price momentum, 6 month price momentum, 12 month price momentum, maybe 18 months. But that's about it, and there are some very short-term momentum players that look intraday or on a daily basis. But most of these signals are concentrated around 12 months and 200-day moving averages, right? So that's why when people look at the 200-day moving average, they first, when 20 years ago, when someone told me, I said, what is this magic? Why would this work, right? But its reality is that many models, systematic models primarily, it's computer-driven, but also psychological investors look at these things and become self-fulfilling. So you need to actually come close enough to these levels to break them, right? So for instance, earlier this week, S&P got below around 6,000 or a bit below. We were close to breaking 20-day moving average and 50-day moving average. So you can think of it as about 1 month and 3 month price momentum. So that's about a third of a signal. The big signal is really 12 month, or 200-day moving average, right? But when you start moving things, you can actually unravel. It's like a little bit like a snowball. So I thought like if the market is going to stay below 20 and 50 days, at the end of the day, you may get enough selling from CTAs or de-risking from CTAs that they may get you to another leg lower, right? So it's basically you need to have a setup that you're close enough to these triggers on the downside to move it. And again, I think this week we got very close, but there was also other flows like rotation. You saw like selling on NVIDIA, but Apple and Meta went up. So at the end, Nasdaq dropped, but did not drop a lot.
Joe, it kind of reminds me of like structured credit notes where there's that knockout level, and then you get this massive cliff risk and the whole thing kind of unwinds.
Right. You have all these rules-based investors and something happens, they're like, oh, the model says to sell. It is worth noting that as we are talking 10:19 a.m., January 30th, NVIDIA is basically right at its 200-day moving average. I know this isn't the broader market, but it's a big part of the broader market. So, yeah, it might as well be. One thing that struck me on Monday, which I was a bit surprised about in the sell-off, is that even on Monday, you mentioned that Meta actually closed green. And they are a maker of a competitor to DeepSeek. They have their open source Llama, but they're seen by the market as a consumer of AI services because they don't sell their product. They use it to do things like better ad targeting, et cetera. Were you surprised that even on this day in which there was this sort of exogenous shock to the market, everyone wakes up to some new thing, that actually investors showed a fair amount of discrimination in terms of what they dumped?
Yeah, so I mean that was again, January sentiment is still pretty positive.
Yeah.
Economic data are strong. So people are saying, okay, this is not the beginning of economic downturn. This is isolated sort of event whereby some companies will get hit, their sort of revenues will get hit.
Yeah.
And some will be able to do things for cheaper, so you had a Salesforce, I believe, as well. And so it ended up not a macro day, but more of a rotational day. There is also so-called quant factors where, even within technology, some stocks are higher multiple, some stocks are lower multiple, some stocks are more momentum, less momentum, so there was a bit of rotation. So Apple, which was a laggard, also kind of caught a bit, although I don't think there was much fundamental stuff going on for Apple. It was probably just rotation. So market kind of held up, and I was sort of at the fence whether these like technical levels 2050 will get broken and will go lower or not. We didn't, but I do think that sort of valuation, positioning, and some of these technicals are a bit stretched. So I don't see like a huge upside for the market. So maybe I'm switching the topic a little bit, but
no, that makes sense.
Can I ask you a sort of procedural question, which is, you were at JPMorgan for 20 years and you were in the industry even before that. How did your sort of research and forecasting process change throughout those years?
Oh, thank you. And it did change, and it's an interesting, good question. So I got my PhD in physics, in theoretical physics. So there was a lot of coding, there was a lot of modeling, there was a lot of sort of trying to understand why one thing leads to another. What is the cause? What is the concept? What's causality? And what's the noise? What's statistically important? What's statistically not important? So in physics, you build this type of models. You try to understand what's significant, what's not, what you can neglect, which factors you have to take into account, and most importantly, how to simplify the complex. Market is an extremely complex system. Many is physical systems. So you need to sort of move the noise on one side and drivers on the other side and try to recognize those patterns, right? So although I really never used any formula from the physics almost never really, in finance, but the way of thinking is similar. So I started Merrill Lynch in derivatives research, where I started looking, interestingly, we are now in earnings season. So my first models were impact sort of earnings on a stock price and what can you read from options market, so I published some papers, come up with some formulas, and we were kind of backing out, okay, what the option market is saying. And then we would go to analysts and say, hey, do you think it makes sense or doesn't make sense, right? And then if you think that options are saying too much of a move or too little of a move, you could trade these options and stuff like that. So that was one example of, okay, how do you sort of, you have a catalyst, you look at different markets, you see, are these markets aligned? You put some model together, and then you find a discrepancy with the model. It's not always going to work, but if you do it for 100 stocks, maybe on average on a portfolio level, you'll be fine. So that derivatives research and quant research, I did a lot of quant research. So you try to process the data, you try to look at the measures. And at that time, 20, 25 years ago, it was beginning really of trading of VIX, of volatility swaps, of correlation, of dispersion, so you kind of try to see, okay, you look at the VIX, you look at the market volatility, what's driving market volatility? Well, people say, well, it's a panic or it's not, but let's be more quantitative. You can see how correlated stocks are, what individual volatility of each stock is, which part is due to the macro factor, the market, what's idiosyncratic. So you can kind of break this down. Then you can look at the sector, what's correlation between sector, what's correlation within sector. So you can kind of quantify these things and analyze and get some insight. Like 2008, for instance, we look at 2007, 2008, I look at how the hedging of options impacts the market. So you basically need to look at how many options are out there in index, let's say. You try to assess what's the positioning from the flows, from the sort of knowing of industry, hedging flows. And then you see, okay, what are the hedging requirements at the end of the day? And 2008 and then 2011, and they're like low-hanging fruit. You could see sometimes these flows would be bigger than market can absorb, and they would all go same way, from levered ETFs, from options, so you see okay, there's $20 billion to sell and market can't absorb that. So market towards last 10 minutes will drop. And that's, you mentioned sort of Gandalf, that's where some of these things, because people, if you look from the outside, you say, oh, how can he get that, right? But it is really understanding a bit of technicalities, which is flows, option, convexities, liquidity, and how they sort of interfere. But, after 2015, 16, people figured it out, and then people put it in their models. They create a structured product.
After 2018, everyone sort of woke up to the VIX, especially, right?
Oh yeah, February 2008, Volmageddon, and stuff like that. So you kind of analyze causes and consequences in the market, something that is new, that's not been yet a look at, and I have focused on things that were new in the market, like products, options, futures, CTAs, those type of things.
It's not particularly technical, but another thing that seems to be true about the market right now is, at least maybe up until a week ago, and there's just an incredible amount of optimism in any sort of measure. So if you ask, there's consumer measures. Do you think stocks are going to be higher in a year from now? Very high levels. If you look at things like the Bank of America sell-side analyst sentiment, very close to euphoric levels. If you look at fund cash levels, extremely low right now. Everyone is overweight long tech. How do you ingest this information? Because on the one hand, you say, oh, everyone's all in. This is negative. On the other hand, people have been very optimistic for a while. How should we, as consumers of this information, think about what it says about the fragility of the bull market?
So, clearly in the markets, things are mean reverting, so when things reach some very high levels, eventually they
can go on a long time.
Yeah, exactly. So there is this mean reversion, but there's also trend, right? Figuring out the timing of that is hard, right? If there is a sort of a limited set of drivers, like in some of these technical markets, so for instance, CTAs, once when all the levels are positive, all the signals are positive, and then volatility drops a little bit, they're maxed out, so they're not going to buy more, right? And so that's a self-contained isolated system where you can say, okay, optimism is too high, so there's the only downside, right? With the entirety of market, right? You have a crypto, you have a fiscal measures, you have monetary stimulus, you have a sentiment shifts. It's hard to handicap all of those, so it's hard to say that for all of the investors to be able to know exactly when this thing is going to stall, right?
Sure.
And there are developments that is hard, like, this whole AI, and I see I wrote a book in 2017 about AI with my colleague Rajesh, 2018. So we were early on AI, and 6 years ago, right? Nobody was talking really about it at that time. So it's not that I don't understand it, but I'm a little bit cynical about it now. I think it's too hyped up, right? But it's hard to assess how long people will be excited about it, right? And then you have changes. You have political changes that can bring deregulation, that can be change in tax regimes. So you have like a wild cards. So it's hard. Your question, I started like there is a reversion always, but where you're going to pick it can be very frustrating and very sort of you can be wrong for a long time.
Wait, can I just press you on that point about AI? Because I think the difficulty that investors are having is AI has a great story right now. And there's this idea out there that it's this revolutionary technology that's going to change the world. Joe keeps referring to it as inventing God when it comes to AGI, at least. And at the same time, there is also a feeling that people are maybe getting a little too optimistic about it. There's too much hype in the market. You've started seeing companies that, just put out a press release going, oh, we're looking into AI, and their stock price goes up. How should investors handle their exposure to AI? Like, how do you actually play it at this point in time, given that you were early to the topic?
And now cynical.
I look at it from theoretical side. I look at it more how to apply it sort of in finance, in quantitative trading, how to use large language model to assess the sentiment, changes in sentiment, and those type of things, right? So, how to read quickly things and summarize them and derive some signals out of it. So there is obviously bigger question of AI, which you said is kind of philosophical questions like, are we going to be replaced? At which point, what's going to be the role of human once when we can, kind of break down our way of thinking and effectively train it and replace it, So there are a whole host of other questions, so I'm not skeptical that this is going to be hugely important, and it is hugely important, It's not very, very different of what people have been doing 5 years ago or 10 years ago or 20 years ago. Obviously, big progress in computing power, big progress in the models as well. So it's. But I see it like more as an evolution. Than something that changed with ChatGPT in 2023, like 2 years ago, as a kind of like a step function. I see it as an evolution, always important, right? Like 10 years ago, when we use our smartphone to take pictures, like camera would recognize the face, it would zoom into face, it would kind of do the proper focus and stuff like that. So that's also AI, and things are advancing, right? And we'll keep on advancing. Now, question is going to be winners, losers, how to monetize. Does that suddenly re-rates all of equity market multiple? Like suddenly, okay, people are not going to work. These companies go to all the work, so we're just going to value them. Like, who am I to say that? And also, who am I to say that that's wrong as well? But there's a lot of speculation and a trust. People often tell me, well, imagine just how my way to search internet has changed. Okay, like we were searching internet for 25 years the same way. I used to use like a Netscape like 25 years ago, right? And the same thing, you type in a bar and you find something. So for Christ's sake, of course it's going to change. Of course, at some point it's going to be, we're going to tell something to computer will have its own ways of parsing and finding what's relevant and giving us back information. So I'm not as excited about that change. I think it's a way overdue change, but there is a lot of optimism now.
Well, I was wondering, because I was looking at your LinkedIn and you mentioned you have a PhD in physics, graduating from NYU in 2003, theoretical high energy physics, cosmology, string theory, and finance. I guess a two-part question. A, do you think there's a world in which if you graduated today, you would have gone into AI instead of going into finance? Because I imagine they would have hired you at those skills. But B, like, would you think about, and Tracy mentioned, like the true AGI, do you think that the current AI research is on a path to that sort of AGI inventing God that a lot of the proponents believe?
So, I think eventually it will get there, in a sense that it will sort of address some very important, questions which are kind of deeply what every person fears or wonders or sort of seeks, kind of meaning of our lives, like, future after we die and stuff like that. So there are definitely interesting things there that can be done. I mean, people are doing with these like assistants, right? Like you train And I believe really this AI will have to be a lot more personalized, so you will train it really on your life experience, so if AI can see every image I saw, if it can read every email, I believe AI will be able to tell me when did I make a mistake, when should I do something different, did you overreact in this life situation, did you not, right? And going further, right, like that will stay. And my kids can, after I pass away, they can say, hey, what would Dad say in this situation, right? What would, maybe I'll be able to in some way talk to them, right? So you'll blur all these things which were sort of not blurred in the past, right? So you'll start having these like very, very interesting developments, but I would kind of not look at them from the sort of P&L perspective, earnings perspective. There's also going to be a lot of issues as we have already now. I mean, sometimes AI can give you wrong answer. Sometimes it can be used to do bad things, to impersonate, to deceive, to manipulate. So there's going to be a lot of interesting, I would say, philosophical issues, technological issues and investing issues. But I just don't think it's going to be as simple as like 7 companies are going to have PE of 50 and everyone else will have PE of 10, and it's going to persist that way.
Yeah.
I don't think it's going to be like that in finance, at least. Yeah.
The other thing I wanted to ask you is, you left JPMorgan in July, and then pretty much a month later, we had a very sharp sell-off. When you look back at that particular sell-off, we never got to hear from you, your thoughts on that particular week in markets. What did you actually see and observe there? Because there are still differing opinions out there about what the proximate catalyst was for some of those moves and what was exacerbating what.
No, so the catalyst was definitely moving rates related to Japan and the currency, right? That was a sort of catalyst. But you always have like a spark and a bucket of fuel, right? And the bucket of fuel is stretched CTAs, stretched vol targeters, systematic investors, too much optimism, and then you start basically hitting the stops across these strategies, right? CTAs hit their sell signals, vol targeters, VIX goes up, vol goes up, they need to sell. If you were selling puts on AI names, you suddenly need to, you need to kind of close. So VIX behaved most anomalously. So it was a lot of short vol covering as well, But again, I think it was what was missing for this to be the turn in the cycle was, I guess, GDP, employment still fine, right? Still hope that Fed is going to cut,
right?
So it didn't. There was a little bit of conflagration, but it didn't kind of burn everything down, right? So it was a little bit of satisfaction, but it didn't last too long.
It is pretty remarkable because even we got a little sell-off, but it's a very minor sell-off. Where basically the stock market is more or less at all-time highs. This is despite a pretty big repricing of the expectation of the short end of the curve, where people were expecting deep cuts to continue through last year and to this year. We might not get any cut this year, and yet still the market is close to all-time highs. It must be nice on some level to be out of the game of having to come up with an end-of-year price target, because that sounds like a job I would never want to take. But I also wonder, do you wake up in the morning and still like
yearn to give end-of-year targets?
So talk to us about, what you have a market outlook for right now. Like give us what's on your mind.
Sure. Like so look, it's nice once in a while that you can be somewhere away and not look at the Fed, parse every single word. Although I did it yesterday, but a few months ago I didn't, so it's nice to make a break, or maybe it's necessary. Ultimately markets are a little bit of a sort of compulsion. When you feel like you need to understand what's going on in the world, so I think it becomes part of your DNA if you do it for a long time. So I do always think, and I do have an outlook.
Yeah. So give us a.
On the sell side, you kind of need to put a price target, and I think it's a kind of poor way to summarize everything into one number. It's basically almost you're trying to forecast probabilities in the world, because real world actually works in terms of physics, deeply works in terms of probabilities, not just superficially, in a quantum physics. So you need to sort of have a sort of that type probabilistic view, and you're forced to have one view, like 100% or nothing, right? So it gets oversimplified. I think media, and not referring to you, but media does a bad job. They say, oh, what's your price target? They just want to talk about that. And they say, oh, you're right, you're wrong.
Right,
That's
so
okay. Joe just did that.
Yeah, what's your price?
Yeah, so I would say, like, if I can move away from price target, I do think we'll go back down in the 5,000s this year sometimes. I think at that point in time, we will see whether the cycle is still strong or it's not. I think we need to see the whole new political climate, whether it will lead to turmoil. And I believe more likely than not it will. So those things I think will get us lower, right? At that time, whether it becomes an end of a cycle and we go much lower into 4,000, that I don't know. I think there's some probability of that, And then conversely, on the upside, is everything goes, if really this is what they call it golden age of America, then market will stay in 6,000s. It can go a bit higher. I'm hard-pressed to see it going much, much higher, right? Because valuations are there, positioning is already there. As you said, Fed is not cutting, right? So it's a little bit of a chicken and egg. I mean, I have been scratching my head at these level of rates, which I do think are restrictive rates for now, more than 2 years with the commercial real estate. Here and there, we saw a few hiccups, but I do think that is sort of under the hood of economy, some damage is being sort of built up and down. So I don't think market really, going to 7,000 or, 6,800 or something like that. So I would say maybe it can go 65, stay range bound, so I would sort of formulate the view in terms of, okay, you perhaps want to sell upside, give yourself a little bit of a room for some more excitement first few years of the first few months of the year, but then also be ready to assess once when you go into, let's say 5,500 or 5,700 to assess, is the cycle potentially ending, or that's going to be buying opportunity. And I wouldn't want to sort of say, hey, it's going to first stay at 6,100, then it's going to pull to 55, and then you buy with both hands at 55, and that would be too predictive, But I think some variation of that path will be whereby sort of the depth of a pullback will depends on trade war, China, domestic political situation, rates, and one-off things like we had on Monday.
I'm glad you mentioned domestic politics, because one of the other weird things about this week when we had the DeepSeek sell-off was everyone was focused on that. And, tech stocks went down, as we mentioned. But then on Tuesday, everything started rebounding, even though we had headlines coming out of the White House about cutting what amounted to a pretty big chunk of federal spending. The entire market seem to look through that, which is kind of ironic because one of the things we've heard for the past 4 years or so is this idea that, deficit spending is driving the entire economy and stuff like that. I feel like political risk is one of those things that investors really struggle to price in because there's so much uncertainty. A lot of it seems very binary. How do you deal with that?
So you need to sort of, put some scenarios, what can happen in terms of taxes, regulation, tariffs, trade wars, geopolitical conflict, and then see how can they impact specific stocks and industries, countries, and maybe overall market sentiment, and maybe put some scenarios. That's a kind of a blueprint, and market never goes by that blueprint, but at least gives you some framework to try to understand if it doesn't go by your sort of assessment, what have you missed and what else you need to take into account. But you put some blueprint sort of what can happen. So, I think you pointed very well. He was talking about NVIDIA, Taiwan export sort of, so those type of things, right? So market has its minds of its own, which is tied to sentiment, and it's tied to momentum. Most people think momentum, they don't calculate it, but they think. They just feel good about market. They see good news about market. Their taxi driver or friend or family feels good about investing, right? And they choose then to ignore, so on Monday I was watching CNBC and every single guest was saying, oh, take your shopping list out, buy this, buy this, right? So it creates a little bit of a sentiment, it creates a sentiment and people say, okay, I'll make a punt. I'll buy if it's 20% down, maybe next day it's going to dead cat bounce. So people buy, right? Some people rotate, say, okay, I'm getting rid of NVIDIA, but look, Apple has been, underperforming, so maybe I put my money there. So the sentiment overall was still pretty strong. There's this aura of momentum, psychological momentum that is harder to break. You do need to have a few punches for it to break, for people to sort of give up.
So one of the other things I want to ask you, just again, looking back at the sort of long-term changes in the market, and we touched on this earlier, but we've just seen an absolute explosion in different types of options trading and volatility trading. And now you even have TikTok influencers who are like pitching options investing as passive income. Like, oh, don't buy a US Treasury bond, do an options bet, which is kind of crazy. How has that impacted the market, and how have you seen people trying to handle some of that new I guess dynamic that's been introduced?
So that's a very good question, and it started sort of with around the COVID time. People were locked in, they got these stimulus checks, they started trading, right? Proliferation of these online brokers, no commission fees, options being traded as a sort of very shorter and shorter maturities, right? Options used to be sort of leaps, and then maybe like a monthly options, first, second, and third month, quarterly options moved to weeklies and dailies, and then in the single names, so you had sort of people locked, they got money, and they got these instruments, these extremely powerful instruments with leverage, about 100 times leverage, so you suddenly can make a bets of, millions of dollars, even if you have $10,000 or $5,000 to invest, so that changed. That changed a lot. And for most of these people, actually, it worked, right? Because since 2020, we had that pullback when the Fed started hiking. But for most of it, it worked. So speculative trading activity, especially on the long side, it worked. Then you also had in parallel sort of crypto markets growing, right? So if you think of it, few trillions of dollars of wealth was created there. With probably some of these similar type of investors and similar type of people, so it changed, so there is less leverage in terms of borrowing money when interest rates, but a lot more leverage in terms of option trading activity, So as you said, I'm always also surprised you go on some of these social media and then you see all kind of strategies that can't lose money, that are making like tens of thousands every day. You just need to follow him. And it becomes really kind of bizarre. You have like these people who are at the same time performer, or like women who are like, in underwear suggesting how to trade options.
Buy 0-day options.
Yeah, they're all big fans of mine. They follow me on Twitter and then they DM me. I'm very flattered.
So it's kind of crazy, and we try to handicap it by looking at flows from Robinhood, see which names are being sort of bought, which names are being sold, try to see where the retail may be forced out or something like that. So we did some quantitative work. We did a lot of the sort of large language models sentiment-wise, like from Twitter and those type of other social medias, which we could get permission to do. So we're trying to incorporate it, but I think overall it's hard to 100% handicap it, but for sure it added leverage to the market, added speculative element to the market. And at some point, it's not going to probably end up well, right? At some point, but it's hard to say when exactly.
Right. It's, again, one of those things that can go on for longer than you think. Since you mentioned getting data from Robinhood just then, this is the other thing I always wanted to ask an equity derivative strategist, because you alluded to this earlier. There's a lot of, I guess, misunderstanding or lack of understanding of what an equity derivative strategist actually does and exactly what data they're looking at in order to make some of their conclusions. Can you maybe give us like a quick 101 in where your data comes from? How much of it is from official sources, like, I don't know, an EPFR or someone like that, versus like color that you're getting from the market?
Good question.
Yeah, no, so they're all kind of data. So there are price and volume data, all kind of technical data that can be derived from those type of things, which can also be at different time horizons, they can be daily. Mostly they are daily, right? But increasingly you also want to look at the intraday data, intraday correlations, intraday momentum, volumes, large blocks that are traded. So there's also high frequency one day, but most of it is daily, I would say. And then there are longer term data, when you look at the sort of, some like a monthly statistics on positioning, or up to the sort of filings, 13F filings like holdings and stuff like that, so different sort of frequencies of positioning, volume data, price data. Then, so directly market observable data like open interest, options, volume in options, those type of things, right? Then you have sort of fundamental data, and fundamental data, you have fundamental data for stocks, which are related to earnings. But increasingly, you have a data which are derived from non-traditional sources, so-called big data that can be sort of sentiment measures, but quantitatively derived measures, objective, not sort of guesswork, to some very specific niche data like, satellite, all kind of like data that, we didn't have,
How many cars are parked out shopping
parking
malls
lots and in front of Walmart and those type of things, right? So you have these stock-specific data, earnings-derived, news-derived, sentiment-derived, and then also non-traditional ones, and then you have like macro data, typically lower frequencies, but increasingly also with some of these alternative data sets, big data sets, you can try to figure out like, shipping and, again, sort of storage and oil tanks, how full they are and stuff like that. So it's a whole host of data, like as a quant and derivatives person, you probably focus most on the market data, so open interest, price, volumes, and all stuff that is derived from that. But you also want to supplement that with all these other data, and then some of the data sets you derive it on your own. So for instance, gamma imbalance in S&P options, put minus call. So I was running that for 15, 20 years, and first people tell me, what's that? That's you cannot know what's But then now everybody has it actually. And same thing with like a CTA stuff. And vol targeting exposure, I was getting so much sort of critique in 2011, 12, 13. Now everybody has it, kind of CTA positioning percentiles. So you can derive some on your own based on your understanding of the markets.
All right. I just have one take, and I bring it up a lot. And I sort of feel like the Kool-Aid man. It's like every conversation I have to jump it through the wall and interject this. But, there's all sorts of like quant techniques, and there's the definition of quant and changes over time. And obviously there's an incredible amount of data that we can use now. And then there's sort of like old-fashioned quant where you're just like, we're going to buy, that I sort of associate with like AQR from years ago, where like we're going to buy the cheap stocks that are exhibiting momentum, right? And we're going to short the expensive stocks that are declining momentum. And, why doesn't this work anymore? And all these sort of hand-wringing in the traditional quant industry. Why haven't things mean reverted? How much is the fact that like so many of these sort of ideas about how the market should work have been broken by the simple fact that a handful of American companies that are very big exhibit year-over-year earnings growth that are truly remarkable? And this is a fact not about the market world, but about the real world, that for whatever reason, these big tech companies just keep getting bigger despite their size.
Wait, Joe, you have to end that by saying the Kool-Aid man catchphrase.
What did he say?
Oh, yeah.
Oh, yeah. As long as the Metas and the Googles and the Nvidias and maybe the Apples of the world just keep growing earnings like crazy every year, how much does that bust any sort of notion of mean reversion in markets?
No, so I think it busts the notion of a value as a factor, but value as a factor has been struggling for a long time now. So sort of probably since, decline in interest rates post-2008, a lot of these, and growth of indexation, right? Growth of indexation kind of sparked the momentum and changed the structure of the market. So some of these quant models or quant factors work less and less, There is also another aspect, which is, once when you put money to work in these strategies, you kind of squeeze out the alpha, and these things are fully priced in, so they stop working. So sort of growth of quant funds, traditional quant funds, you have quant ETFs, you have like broker dealers doing quant strategies, kind of squeezes out returns, right? On your question, sort of like these big companies that keep on delivering, that's also a very good point. Quant strategies are designed for sort of steady state situation when kind of things are fluctuating around something which is in a steady state. And we had sort of, big changes in the world, right? In technology. Yeah. And also geopolitically sort of, capital moved to US and it moved into this sectors of innovation, right? And now, so you may sort of, you may constantly be out of equilibrium, right? Where some of these mean reversion or quant strategies would work. Certain type of quant strategies, value-based strategies, right? Question is how long can, going back to the concentration, right? How long can it go? My question becomes like, let's say if you have like a social media company like a Meta, right? I mean, once when they have all the users in the world, I mean, like, they can't go much further, right? They can go to the
Right. There's limits.
There's
market
limits,
growth.
you know, but
They have to
number
start creating fake AI.
fake AI, or go like to Mars, like
Yeah.
but there's no one there. So there's some limitations, right? Like, and then there's some sort of also historical when you look at the weight of stocks in an index, right? So you take NVIDIA percentage weight in S&P, and you run back history and you see that this basically never happened. And even if it happens, it never lasts forever, right? But to your point, it can last, 1 or 2 or 3 years is enough to ruin a lot of investment strategies. Yeah.
All right, Marko Kolanovic, thank you so much for coming on Odd Lots. A real treat for both of us.
Yeah, that was great. Thank you so much.
Thank you so much.
Joe, that was really fun. I'm so glad I finally got to ask him a bunch of questions about just being an equity derivative strategist that I've had on my mind for a while.
I love those questions so much because they're this sort of like dark fiber or the dark matter of how this industry actually works, but everyone just abstracts over them. It's like, oh, you look at the data and then you do this thing. But like,
right, like what data?
Where
what
did
are you
the
looking
data
for?
actually come from? Like, I could listen forever to someone, and we should do more of that, just like talk about these aspects, like paying for data and data costs and all that stuff. I really like Marko. It was a nice conversation.
The one thing I would say is, you asked that question about like, well, the S&P 500 overall didn't do too bad on Monday. And like, if I'm an index investor, I have exposure to GE. And so that's good because I don't have to worry about AI. But I think the question really is like, how much is GE exposed to AI in very indirect ways?
Yeah, that's correct. Right. And you do you know what? I think I saw a tweet about this, so I'm just going to say it. And it may not even be true, but if it's not true, it's truthy. Someone tweeted that apparently there was like a Sherwin-Williams earnings call, and someone asked about how much paint data centers were going to need to paint their walls. I don't know if it's true, but because I just saw the tweet. But if it's not true, it doesn't really matter because it is true. Like every company is like, are you doing something that could supply? Do you sell some product that someone building an AI data center is going to need at some point? But my point about GE, though, is kind of the opposite, which is like GE did fine on that day, but I wish I had more exposure to GE. What I really have is a bunch of NVIDIA and Microsoft exposure through my index fund.
Right. But you don't know how much exposure, indirect exposure you have to NVIDIA and Microsoft through GE.
This is true.
Like,
this is true.
Skanda wrote that excellent column in the Odd Lots newsletter about how more and more of the economy is being driven by AI. We actually saw on Monday the Treasury market move a little bit, which, Treasuries will go up when there's a market sell-off, but a lot of people were saying, well, this impacts growth expectations as well. And so that's why you're getting this reaction. Anyway.
No, totally. I think the degree, especially, you go back and like Trump announced the $500 billion Stargate project, and I don't know what's really going to become of that. But like, I believe the data centers and AI specifically through the data center channel is a growing important part of the real economy right now. And if suddenly they're like, you know what, this is a dead end, or suddenly like, we don't need this because we can get AGI so cheaply that it's just like on our laptop, that would raise some real econ concerns.
Yeah. Shall we leave it there?
Let's leave it there.
Oh, yeah. This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Marko Kolanovic. He's at Marko in NY. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks. For more Odd Lots content, go to Bloomberg.com/oddlots, where you have transcripts, a blog, and a newsletter. And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you like it when we discuss the dark magic of equity derivatives, then please leave us a positive review on your favorite podcast platform. And remember, if you are a Bloomberg subscriber, you can listen to all of our episodes absolutely ad-free. All you need to do is find the Bloomberg channel on Apple Podcasts and follow the instructions there. Thanks for listening.